Welcome to the Robert Hunt Financial Market Update. It's your host, Robert Hunt, where I look at the week's financial news that can be a bit confusing, misleading, and take you off course and help to make it actionable, understandable, and clear. Happy Independence Day. Happy July 4th. We've got a great show for you. We're looking at 3 articles, 2 in the Wall Street Journal, 1 in the Dallas Morning News. In the Wall Street Journal, we're going to be looking at how making money on elections is harder than ever. We'll splice and dice that. This was fascinating. Another article, Wall Street bids adieu to its biggest bear. So JP Morgan whiz kid gets fired for incorrect market movements, guesses. And then finally, we've got a customer beware section where we're going to talk about the dangers that can be had with your money at various banks and security. There are folks who are spoofing and tricking customers at banks, and it's getting pretty good. So I want to talk about what not to do, what to stay safe with money. At the top, Mr. James McIntosh. Making money on the election trade is harder than ever. The obvious lesson. Trades based on voting results are a gamble on unreliable polling. So I pulled this article not just because of the article, but also because I'm beginning to hear it a bit more. The phrase, well, the election's coming, Robert, so you know what that means. And I try not to be too coy, but in my heart I think, no, I have no idea what that means. The danger, as I see it, is that we can think too much of our ability to prognosticate markets in any environment, but especially with elections. This idea that we can somehow know the market movements under Democrats or Republicans and therefore make anticipatory investment decisions based on those movements. There is a robust data set that looked into that, and it shows you can't do it. You can't do it. For all of my conservative listeners out there, I know there are many of you, it can be a difficult truth to hear that under a Democratic president, the stock market is at all-time highs. And yet, for the investor who elected to sit out when their respective political party did not get into office, consider the gains they would have had to leave on the table. It's been quite a run. So the answer is not, oh, gee whiz, let's seek to anticipate who will win and bet on it. No surprise from this podcast. The answer is don't pay it any mind. Of course, elections matter. It's simply that you can't make a predictive bet based on the outcome of those elections. You can't do it. So this article by Mr. McIntosh actually goes into an arena. He probably thinks more of our ability to predict money movements than even I would, and he's pretty skeptical. But he talks about what's going on in Europe. There's obviously French elections. There's a far-right national rally group. If they win a bunch, they're seeing movements in French bonds. And in the U.S., you're starting to see Donald Trump appears like he will win the presidency and potentially the Congress. So there's thought that the 10-year U.S. Treasury yield is jumping because he's a populist president. We'll have soaring deficits, which mean interest rates will rise, inflation will continue. What I fear is that all these little nuanced moves of this, the article continues in Mexico and India. It's that you're not going to be able to hang with investing if you're committed to making moves based on elections. I think you will go mad because politics is all about optics a lot of the time and not about substance. So if you do listen to the news and follow on both sides, follow some of the extremes they're giving you, it's going to be tough to stick with it. So I recommend a news diet and remembering that what does the data show? The data shows it's not like if your guy wins or your guy loses, the stock market cares. Stock market doesn't care. Doesn't care. So keep that time horizon long. Stick with it. Next article, Wall Street bids adieu to its biggest bear. So I guess I didn't listen to this guy a lot, but this is J.P. Morgan's Marko Kalanovic. He had a knack for making aggressive calls, the article says, but now the analyst is out after missing a roaring bull market. So this article explains that this man had nicknames. He was so good. They called him Gandalf and Half Man, Half God. These were given by the financial press over the years for his prowess at predicting market moves. He is now out of a job at J.P. Morgan, which we do not delight in at all. At all. This guy could be a swell guy. So this Kalanovic called for a recession, hadn't materialized yet, and he completely missed the artificial intelligence boom that has been propelling tech stocks, and as a result, the entire market. So check this out, listener. J.P. Morgan, they got a pretty big budget for this sort of thing. Their current research view is the S&P 500 will tank 24% by year-end. Kalanovic warned in one of his final reports out last week of a clear disconnect between stock valuations and the economy, diminished liquidity, and narrow leadership that is masking weakness. So, as a Robert Hunt Financial Market listener, we're stepping back and we're saying, this is supposedly regarded as the greatest analyst. If you're half man, half God, or Gandalf, I happen to like Gandalf a lot. So, that weighs heavy with me. You must have some influence and have earned some sort of position on the market predicting ladder. If this guy, who's at a well-regarded bank with infinite resources, it seems, can botch it this bad, this should be the nail in the coffin for anyone who's trying to find someone to tell them what to do. I was talking to someone about this past week. The whole premise for many advisors is their ability to keep you out of trouble. They're going to avoid the bad stocks, avoid the bad markets, ensure that someone is watching your money, shepherding your money. And the problem is, if you remember The Wizard of Oz, when Dorothy goes up and looks behind the curtain, Oz the Magnificent, it's just a little man pulling various levers. It's an illusion. That analogy holds true with folks who are making predictions like this. I suspect this gentleman, Marko Kalanovic, is smart. So check out this bio. He's a 48-year-old native of Croatia. He earned a degree in classical music before coming to the U.S. to study at New York University. He got a Ph.D. in theoretical high-energy physics and started a Wall Street career in early 2000s. Joined J.P. Morgan after acquired Bear Stearns. So, I mean, that seemed pretty good, right? If you get a PhD in theoretical high-energy physics, I mean, I'd compare that to a finance degree from Texas A&M. It's so good. So we've got to give the man some respect here. He actually made a series of short calls. Oh, he rose through the ranks and attracted widespread attention as a derivative strategist in 2015. He made a series of highly accurate short-term calls on the direction of the S&P 500 based on how he expected quantitative funds to react to increased volatility. So here we go. Here's how it happens. Past performance. Isn't this how we choose these soothsayers, these market prognosticators? We look at who did it well in the past. I have seen more money lost following men like this than at the end of a gun. And it's seductive because who doesn't want to know when to get in and out of the market? And then, oh, by the way, someone comes out of the ashes from Croatia who studied classical music and theoretical energy, whatever, and he's correct. He has a history of correct predictions. Wow. So I like this line in the article. The journalist writes, if the first rule of forecasting markets is to be right, the second rule might be don't be the only one who's wrong. So check this out. The S&P 500's 45% rally since the start of last year caught most of Wall Street by surprise. But the naysayers naysayers slowly capitulated. So all these bears were like, okay, yeah, I'm going to quit. I think the market's going up. This gentleman, Kalinovich, stuck with his prediction. The market's going to crash, and it didn't. I think we need a regular reminder that the most learned, resourced amongst us can fail spectacularly at something that my children are able to speak into. You've heard them sing about keeping your costs low. You're investing something your time horizon long. Mr. Kalinovich is not doing that. He rose to the ranks by perhaps avoiding that. But when you're talking about preserving capital and growing capital slowly over decades, it is not a good idea to follow guys like that. Be willing to not listen. And our final article, this one surprised me, and it's making me think more and more about protections for you as a consumer. This is Dave Lieber. Get your money back. Don't bank on it. So I read this in the Wall Street Journal. I think this was syndicated. This journalist explains. He says he had a hunch about big banks. It was a gut feeling that banks are much less likely to reimburse customers who lost thousands of dollars because of scammers who pretended to work for banks. So he gives two stories. So this is what's happening. Customers of these large banks are wiring money to the bank, they think. And it turns out it's some scammer. So in one of these instances, a woman lost $25,000. Another one, a married couple, lost $7,700, and the bank ain't getting it back for them. So apparently, this Teresa Murray says this is rampant. The banks cannot keep up with it. Teresa Murray is a consumer watchdog director for the U.S. Public Interest Research Group. They've got to work on rebranding those names. I mean, that's just, I almost fell asleep reading that. The U.S. Public Interest Research Group. So the banks, what they're doing is basically just putting this on customers. So this Randy Benno of Hunt, she still doesn't know how she lost her $25,000 from a wire transfer. She got a text from Chase on her phone and clicked on it. That was the first mistake. A man who said he was from Chase was calling. This lady's caller ID showed the call came from Chase. That was through spoofing. This has happened to me, by the way. I got a call spoofed. It showed up like it was from my local bank. I answer it. And if it wasn't for my knowledge that the bank that they were spoofing was a local bank, the accent of the gentleman calling was so different from anything local that I thought, yeah, I don't know. But it showed up on my phone as the bank. It was wild to me. So this is happening. These folks are out there. So this lady gets spoofed. Person calls from Chase. So it's a national bank. That's hard. You have no idea. Of course you could believe accents don't matter at a national bank. This man warned this lady. She might be a victim of fraud. This lady claims she didn't give him any account numbers and passwords. I believe her. This guy somehow knew it was in her savings account. And this lady said she would normally ever get, she doesn't get taken advantage of. Never happened to her before. But she fell victim to the scam. Okay, lesson is just be difficult, even if it's your own bank. If the bank calls you, I'm almost a believer, and after I've been scared enough by these articles and what happened to me, don't answer. Let it go to voicemail, and you call the bank. Like, actually, you call the bank. A voicemail's not going to hurt you. If you get a text from the bank, you call the bank. You don't text back. There's enough going on right now where it just isn't worth it. You've got an app you can use. Use your app. Another story, Sally Civelo of Dallas. She lost $7,700. Her husband, Philip, said the bank told the couple that it believes his wife initiated this money transfer and benefited from financially. So the bank is so sure that it's the customer's fault that they think the customer actually tried to trick. This is another JP Morgan Chase instance. Customer's trying to trick the bank. Hey, pretend like they're falsifying wire fraud. This husband, sharp guy that he is, said, okay, great. Why don't you charge her with a crime? Bank said they're not going to do that. So the bank says we're still actively investigating and are in contact with them on the next step. So what am I thinking about? This is what they tell you to do. And I like this. Don't engage with unexpected callers, regardless of caller ID. For sure. Caller ID lied. It was a real shock to me. Millennial that I am. I think I'm impervious to these tech scams. I can see through anything wrong. Hubris. I cannot. I was fortunate that the gentleman's accent was so poor and his English was so poor that I knew that it just didn't seem right that he would work for this local community bank here in Dallas, Texas. Just call the company. So just don't answer. Just call them back. Never pay anybody. Just don't pay anybody. Like, just be slow. Be annoying. If the bank says, "Oh no, we need this," and then they say use two-step authentication, I agree. So even if someone gets your password, if you've got two-factor authentication where you have to get a text to log in, that's all to the good. And this reminds me of just credit cards, because the article does mention, you know what the bank is good at protecting? Fraudulent charges on your credit card, because that's the bank's money. It's not your money. So there's a little bit of self-interest going on here whereby we can see, when these folks get scammed out of $25,000 and $7,700, the bank's saying, we're not doing it. You better believe if there was a fraudulent $25,000 or $7,700 charge on your credit card, the bank would fight tooth and nail for every nickel, because that's their money. So as much as I hate debt, hate credit cards, hate people borrowing money, the security protections afforded in a credit card are so positive in this fraud-filled environment of technology that it makes sense to use credit cards a lot. Only if you think you can handle them. Debit cards have plenty of protections too. I use debit cards. You just have to watch them a little more. So with the debit card, if you don't recognize the fraud after a number of days, ultimately it's on you. Whereas a credit card, you're just protected more. The bank just has a higher standard, it seems, on those credit card agreements. But debit cards have a lot of protections. But this article scared me enough, and then my own experience of getting spoofed with my iPhone showing it was my local bank made me think, oh dear, these people must be having success. Clearly they are. So be difficult. Even if it's your own bank, just let them leave a voicemail. You can call them, but the number back. I almost feel like, how often the bank authenticates us and they'll ask you your first, your last, your middle, your secret passcode, whatever, to make sure it's us on the phone. We need to authenticate it's them on the other side. So there's a part of me that thinks banks can do a little more there too when we're talking with the bank on the phone, if the bank ever does call us. Because I have. Sometimes I've had a bank legitimately call me, and it was a legitimate question. I think there's got to be an improvement there where we can know for certain who we're talking to, what counterparty, because the AI voices are getting good. And so that wouldn't shock me if the banker did sound exactly like they normally sound. So be watchful out there, this side of the Garden of Eden. There are thieves out there. So protect yourself. And as always on this 4th of July, let's keep those costs low, that investing simple, that time horizon long, because that's what's going to give us the best shot on our investing journey. Until next time.